Costing serves several important purposes within management and financial accounting, two of the most significant being inventory valuation and profit reporting. Organizations must assign costs to products and services not only to support operational decisions but also to satisfy external financial reporting requirements. The program framework identifies inventory valuation and profit reporting as key rationales for costing because accurate cost information directly influences the value of assets reported in financial statements and the profits presented to stakeholders. Different costing methods may produce different inventory values and profit figures, making it essential for management accountants to understand the purpose and implications of each approach. Inventory valuation refers to the process of assigning monetary values to unsold goods held by an organization at the end of an accounting period. Inventory is recognized as an asset on the statement of financial position, and its valuation affects both reported assets and profit. Under absorption costing, all manufacturing costs, including direct materials, direct labor, variable overheads, and fixed production overheads, are included in the cost of inventory. Consequently, each unit of inventory carries a share of fixed production costs. This approach is widely used because it complies with external financial reporting requirements and provides a comprehensive measure of production cost. The inventory valuation rationale emphasizes the need to match production costs with the assets that remain unsold. By capitalizing production costs into inventory, organizations avoid expensing costs immediately when goods are manufactured but not yet sold. For example, if production exceeds sales, some fixed manufacturing overhead remains embedded in closing inventory and is carried forward to future accounting periods. This treatment ensures that inventory reflects the resources consumed in creating products and supports a more accurate presentation of organizational assets. The resulting inventory valuation is particularly important for investors, lenders, auditors, and regulators who rely on financial statements for decision-making. Profit reporting represents a second major rationale for costing. Financial statements must report profits in a consistent and reliable manner, and the costing system directly influences the calculation of cost of sales and therefore profit. Absorption costing is commonly used for external profit reporting because it aligns costs with revenues through the matching principle. Production costs attached to unsold inventory are deferred until the products are sold. As a result, profit figures reflect both current period sales and the production costs associated with those sales. This provides a comprehensive measure of profitability that is suitable for external stakeholders and statutory reporting purposes. An alternative approach is marginal costing, which values inventory using only variable production costs while treating fixed manufacturing overhead as a period expense. Under this method, all fixed production costs are charged against the current period's contribution regardless of sales volume. Consequently, inventory values are lower than under absorption costing because fixed overheads are excluded from inventory. Marginal costing is often preferred internally because it highlights contribution margins and provides clearer information for short-term operational decisions. However, it generally does not satisfy external reporting requirements because it does not allocate all production costs to inventory. The difference between absorption costing and marginal costing becomes particularly important when inventory levels change. If production exceeds sales, absorption costing reports higher profits because a portion of fixed manufacturing overhead is included in closing inventory and deferred to future periods. Marginal costing, by contrast, expenses all fixed overhead immediately, resulting in lower reported profits. Conversely, when sales exceed production and inventory decreases, absorption costing may report lower profits because previously deferred fixed overheads are released into cost of sales. Therefore, inventory movements can significantly influence reported profits under different costing systems. From a management accounting perspective, the rationale for inventory valuation focuses primarily on measuring and reporting assets accurately, whereas the rationale for profit reporting focuses on measuring organizational performance. Inventory valuation ensures that unsold goods are recognized appropriately as economic resources, while profit reporting ensures that revenues and expenses are matched to determine financial performance. Although these objectives are closely related, they may lead to different preferences regarding costing methods. External reporting generally favors absorption costing, while internal decision-making often benefits from marginal costing because it highlights cost behavior and contribution relationships. In conclusion, inventory valuation and profit reporting are two fundamental rationales for costing within the program framework. Inventory valuation focuses on assigning appropriate costs to unsold goods and presenting assets fairly in financial statements. Profit reporting focuses on determining accurate earnings by allocating production costs to the periods in which related revenues are earned. Absorption costing supports both objectives by incorporating fixed and variable production costs into inventory and profit calculations, while marginal costing provides valuable internal information by emphasizing contribution and short-term decision-making. Understanding these distinct rationales enables management accountants to select the most appropriate costing approach for different organizational purposes.